If you want to learn more about the formulas and theories I use when I analyze companies, go check my website whattheinvest.com. There is a link in the description of this video, and in the section blog you will see a lot of articles in which I describe the formulas that I find most useful. So go check it out. Hello guys, welcome to my channel one more day, and I have to admit that I wasn't planning to record this video, but I was reading probably one of the most important books I have ever read. Actually, it's not a book, it's a mix of letters. You know what probably you will know what I'm gonna talk about. It's the Letters to Shareholders, written by Warren Buffett. And in a future video I will discuss about this book because it's amazing actually, and I really recommend it. Of course, I have to say this is not my original idea. I'm taking Warren Buffett's idea. So please go read this letter. You can find it in the website. There's a link in the description of this video. It's straight to the Berkshire Hathaway website. And there is a section called Letter to Shareholders. Okay, so in there you will see all the letters from each year, and I'm not sure, but I think it's the 2011 letter. So go read it and check the section share repurchases. You will not regret it. This video, as you can see in the title, is called Why You Should Be Excited About a Low Market. Why I'm saying this? Well, because for some investors probably it's nonsense what I'm saying, but for investors like me, that we keep buying shares and we plan to hold them for the long term, we can say that of course it matters if the price goes up or down, but we don't take that much interest, or at least me, I don't take that much interest if the price goes too high. I mean, my goal is not to sell the stock, at least in the near future. Whenever I buy a share, I plan to hold it for as long as I can. If it's forever, better. The point with this is that usually I'm excited when there is let's say a correction in the stock market, because that allows me to buy more shares. And probably now you can say, yeah, that's good. And for example, that's my case now. Actually, I have no money to invest, and all days I tell my girlfriend that why I don't have $1 million to invest right now, because there are so many opportunities in the stock market right now that I'm missing because I don't have the money. But thanks to this idea, now I calm down and I can say like, okay, it's good. Is it still good? If I don't buy shares myself, others are going to do it by me. As you may know, some companies have a repurchase program. That means they are allowed to buy a certain amount of shares, or they can spend a certain amount of money to buy shares. We as investors, we want to spend, we want to put our money in the best assets. When you have, for example, let's say you have, I don't know, $1,000. You want to put that money in the best company as possible. Companies do the same with their cash. They have two possibilities. First, they can use their cash to expand the business, and then if they don't see opportunities, they can repurchase shares. Companies usually repurchase shares because that increases the ownership of their current owners. For example, let's imagine I have a 5% ownership of Disney. If Disney buys half of the shares outstanding, that means I will own 10% of the company without me doing any purchase. That's wonderful actually. Example. In the letter you will see that Warren Buffett uses IBM as an example. I will use Disney just for the sake of change. Let's imagine that today, what day is it today? 22nd of March, sorry. Let's imagine that Disney authorizes a 500 million repurchase program for the next 5 years. So in the next 5 years, Disney has $500 million to spend to buy their own shares. Let's also imagine that Disney has 500 million shares outstanding. Let's say I own 25 million shares of that. So that means I'm 5% owner of Disney. That means in simple words, let's say, that if Disney earns $10 billion, $0.5 billion, so $500 million corresponds to me because I own 5% of the company. Now, there are two scenarios that will happen in the next 5 years. The first one is that let's imagine that the average price of the Disney shares is $100, the average price for the 5 years. That could mean that, for example, next year the stock would be selling at $150, and in 2 years it's selling at $50. The average is $100. So the average for the 5 years is $100. That means that Disney will be able to repurchase up to 5 million shares. That means of the 500 million shares outstanding 5 years ago, now there are 495 million shares outstanding. And as I said at the beginning, I owned 25 million shares. I still own 25 million shares because I didn't purchase anything. But my percentage of ownership changed. Actually, it increased. Why? Because, as I said, in the past I owned 5% of a company with 25 million shares. Now my 25 million shares is equivalent of 5.05% of the total shares outstanding, because now the shares outstanding decreased from 500 million to 495 million. Let's imagine that Disney earns $10 billion. As I own 5.05% of the company, $505 million corresponds to me. The second scenario, let's imagine that instead of $100, the average price for the stock, it's $150 for the next 5 years. That means, if you make the calculations, that Disney will be able to repurchase 3.33 million shares. That means that of the 500 million shares outstanding as 5 years ago, let's imagine we're in the future, now there are 496.67 million shares. Again, let's assume that I didn't do any purchase of my own, so I still own 25 million shares. That means that my new ownership is 5.03%. So why the number is lower than in the first scenario? Because in the first scenario, Disney was able to buy more shares than in the second one. Where in the second scenario, let's imagine that Disney earns $10 billion. So if I own 5.03% of the company, that means that $503 million will correspond to me. So if we make the calculations and we see the difference, there is a $2 million difference. That's a lot of money, $2 million. Actually, you know, it's a lot of money. So you can see what a difference can make when companies can repurchase their shares at a lower price. That's why you should be excited when the market is down, especially if, actually, only if you are not planning on selling your shares in the short term, just if you're thinking long term, because that means your ownership will increase more in a lower market than in a higher market. Of course, there are some bad things that will happen to the economy, to the global economy, due to this low stock market. But you have to think long term, and in the long term, a low market is probably one of your best friends. Just by doing nothing, I mean, now, as I said, I don't have money to make purchases of a stock, but Disney they have the money, and probably now they are increasing my ownership by purchasing more shares, because the stock is so low price that they are able to buy more shares than in a high market or even an average market. So that's it. That's why you should be excited about this low market, especially if you have shares, because your ownership will increase. So if you have any doubts, there's an article I just wrote on my website, whatinvest.com. There's a link down in the description. So go check it, and especially go check berkshirehathaway.com and read the letter by yourself, because probably no, actually Warren Buffett explains this theory much better than me. So go check it, and I'll see you in the next video.